Hello, in this lecture we're going to continue on the partnership problem we started last time. We're focusing in on the capital accounts here, the difference between the book capital accounts and the tax capital accounts, which we have represented in terms of a trial balance format. Here, that difference being there as well as in a table format. So this is where we left off last time, and we're going to continue this time in year 2. Last time we started the company in year 1, and in year 2 we're going to close out the company and go through the liquidation process, the partnership I should say. We're going to close out the partnership and go through the liquidation process. So it's kind of a sad story that we started in year 1, we're closing in year 2, but we're going to learn from the liquidation process here. And we're going to do this as though the entire partnership is going to be liquidated. So we're going to try to basically go through our 4-step process that we would try to go through if we were going through the full liquidation, that being that we would first want to sell off all our assets, then we would want to pay off all the debts, and finally we would then allocate to the partnership, so the partnership owners. So we don't want to do it out of order because we don't really know what we might get for something like the inventory or the equipment, and so we have to keep that in mind, and we'd like to do that first before we start distributing to the owners, so that we don't end up in a situation where we distributed too much. So that's going to be the process that we're going to go through. We'll see what happens to this difference between the capital accounts as we go through this process. All right, so first we're going to take an example of a draw that is taken out. A is going to take out, oh no, we're going to repay the loan. So there's a loan repayment just to see what happens with the loan, because that's going to be the main thing that we're focusing in on here. So we're going to assume that we paid $6,000 of the principal. Now, we're not dealing with any interest on the loan. Obviously, we would have interest to deal with. We're going to deal with the principal. Why? Because that's going to deal with the capital account. That's where the differences are in the capital account. So remember, this loan got allocated out, increasing the tax basis because the partners are liable for that on a personal side. So that's why it affected it over here. So what if we paid off part of the loan? So we're just going to start up. This is before the liquidation process. We're just going to say, well, what would happen if we paid off part of the loan, like $6,000 in cash? So cash is going to go down. So I'm going to copy cash. We're going to credit the cash, pasting it 1, 2, 3. And then the other side is going to go to the loan. That's going to be a credit of $6,000. We're going to debit something, $6,000. That's $6,000 being the loan. Loan has a credit balance. We're going to make it go down, doing the opposite thing to it, which is a debit. So we'll debit the loan here. There's our transaction. If we post this out, then we're going to have the loan. Well, let's go to cap. Now go to loan equals the 6,000, making it go down to 84. And then the cash is going to equal the 6,000 credit, making it go down as well. Now, of course, the issue here is that now this 84 doesn't match our adjustment here, because why? We have to make the adjustment for the fact that we paid off part of the loan. So we can't have this allocation out if we paid off part of the loan. Therefore, we're going to have to say, okay, of this 31, we're going to have to make a tax entry and say that they're not going to have as high of a tax basis in this case. We're going to have to reduce their tax basis by 6,000 divided by 3 if we're going to do it evenly between the 3 of them. So this is a credit balance. We're going to debit their accounts, making it go down by this allocation. So I'm going to copy that, skip a line, and paste it to 1, 2, 3. And it's going to go down by the 6,000 divided by 3. Oh, what happened there? Equals 6,000 divided by 3. And so 2,000 each. And the credit's going to be negative sum, or just that 6,000 negative sum of these items. There's that 6,000. So that's going to be, I'm just going to post that to the adjustment here so that we can see that balancing out in our adjustment. So the capital adjustment then would be over here in the tax entry. We're going to double click on that, going to go to the end of it. We're going to have to say, okay, the balance over here is going to have to go down because they're no longer responsible for that. So we're going to say plus, the balance is going to go down, and we're going to say plus, the balance is going to go down, and then I'm just going to put that into our adjustment account here to balance that out. There's the 6,000 adjustment. If we looked at that in terms of a table, we can take a look at the table over here. So we would have the same information for A, and then we're going to say that A is going to equal the negative of this 6,000 divided by 3 of them. So we're going to take the capital account down, in this case, by the 2,000. Remember, we're not talking about debits and credits here. We're talking about plus and minus for the capital accounts. And the same is going to be done for B. So I'm just going to say B equals the same. And here, now we're going to have the adjustment here as well, because remember that this 90,000, if we adjust this information to get back to what the capital count is on a book basis, so here it is on a book basis, here it is on a tax basis, it would be this adjustment. So that would be the negative sum of these items. And then if we sum these up, of course, there's no activity in terms of the book basis. Book basis being this plus this plus this being the 3,300. 3,300, what are we at for tax basis? The 29.1, the 29.1, and the 29.1 being the 87.3 at this point. All right, so let's see what else we have over here. So we just had the 6,000. So now we're going to estimate that one person draws out. So we're not liquidating here yet. What we're going to say is, what would happen if A decided to draw out $10,000? A saying, I'm going to take a draw of 10,000. Remember, the draws do not have to be equal per se. They have to be in accordance with whatever agreement is there. So A is going to draw out 10,000. So cash is here. We have the cash to do it. Cash is going to go down. So I'm going to copy that. I'm going to skip a cell and put it on the bottom. Pasting it, 1, 2, 3. Putting it in the credit, and it's going to go down. I'm going to represent credits with a negative 10,000. Then we're going to debit something for 10,000. We go ahead and indent this as well. Home tab, alignment, indent. And it's going to come out of the capital account. So capital has a credit balance. We're going to make it go down by doing the opposite thing to it, which is a debit. So only A is pulling out this $10,000. If we post that, then we're going to go here to the capital account equals this 10,000 there. And then we're going to go up to cash up top. I'm going to double click on it, go to the end, plus there's the 10,000. So the cash goes down to 14.3. We still have cash. Note what happens to the capital account, however. Now it's going to go down to a negative for the capital account of 8,009, but there's still basis there. So the tax basis is still there. Why? Because of that allocation of the loan amount. So note that it's possible to have a negative capital account and have still have a positive tax basis account. If we would do that in a table format, we would go over here in the table. We would say, okay, A got 10,000 taken out. So credit 10,000 for the draw from A. That's A's draw, A being the partner, not just A draw. So A draws out, and then we have the total being the sum here. And there we have that. So now we have our capital accounts here at the 19.1, the 29, and the 29.1. All right, so let's go back over here. Now, although there's a tax basis here, the other partners might be saying, hey, you know what, we would really like you, before we liquidate, to have your capital count at least at 0 at this point, and we would like to do the liquidation process properly, which means that we would like to sell off the assets and then have whatever cash we have in order to then pay off ourselves at the end of the liquidation process in case we have losses that we're not aware of during the process. So they might say, hey, A, why don't you bring your capital count back up to 0, let us close out, and then we will allocate what's left over. If that happened, if A then says, okay, I'm going to put back in 8,900 to bring the balance back up to 0, let's do that. We're going to say, all right, cash is here. Cash is going to go back up. So we're going to say cash goes back up. He's going to put back in 8,900. We're going to credit something. That credit's going to increase the capital count. So it's a credit balance. We're going to make it go back up or back to 0 in this case. So there it is. Home tab, alignment, indent, and let's post that. So I'm going to go to cash, double click on it, go to the end. We're going to say plus the 8,009. And then we're going to go down here to A's capital account, double click on it, go to the end, and plus he put back in this 8,009 here. And now we're at 0. We're at 11.1, 11.1. Notice, again, they don't have to be in balance because the draws will differ even if the allocation is the same, which it is in this particular problem. Next, we're going to say that now we're going to start the liquidation process. So now we're going to liquidate, closing out the company. How are we going to liquidate? Well, we're going to first sell off the assets, get cash, then pay off the debt, then pay off the capital accounts. So we're going to sell the equipment first. And it says we're going to sell it for $70,000. We got $70,000 for it. Now you might be saying, hey, why didn't you record depreciation last time? And it's because it's a simplified problem and we're not going to record depreciation at this point. But so we're just going to sell it. We're going to get what we can for it and we're going to take it off the books. So cash, we got 70,000 for it. So we actually got more than what it's on the books for. That's kind of unusual, but that's okay. So that's what's going to happen. So we're going to say cash is going to go up. If it was property, that wouldn't be so unusual. If it's equipment, probably unusual. So then we're going to say 70,000, and then we're going to take this off the books. So we've got equipment on there at 60,000. It's a debit. We're going to take it off with a credit. So I'm going to copy that. We're going to put that underneath. We're going to put it in the credit section, negative 60,000. Now we're going to need, of course, another 10,000 here in order for the debits to equal the credits. I'm going to do that with our negative sum plug formula. So I'm just going to take 70 minus the 60, then flip the sign to give us that negative 10,000 there. What is that? Well, if we got cash of 70 and it's on the books for 60, that sounds like some kind of income or some kind of gain. Now note, it would be like a capital gain most likely if we're selling the equipment, not an ordinary income. For taxes, we're not going to deal with that now. We'll talk about that later. But we're going to put that in here. We're going to say gain loss on sale. It's going to be an income statement account, increasing the income statement. So if we post this out, then we're going to say cash. I'm going to go up to cash. I'm going to double click on it. Go to the end. Scroll down a bit. We're going to take that 70,000, increasing the cash. Now we've got more cash to pay folks off. We're going to go to the equipment. We're going to say that equals, point to that 60,000, taking the equipment off the books to 0. That's what we wanted to happen. Same for books, same for the tax. Now note, of course, it would be different if the depreciation schedules were different. We could take a look at that at a different time. We'd have to make an adjustment for that to take it off the books at different book values because the depreciation rates are different and whatnot. But then we have the gain down here. We're going to say this equals the 10. And now we have income, not a loss. Income, revenue minus expenses. That's going to be kind of like revenue. It's a gain, capital income. And there we have that. Next, we sold the inventory for cash. So note, we might not get as much of a markup as we normally would on the inventory because we're doing a clearance sale. We're not selling it on account. We're just trying to get rid of it. But we usually mark it up, of course, for more than we bought it for. In this case, what we bought it for being 8,000. They're telling us we sold it for 10,000. So it's going to be a normal sale, except for the fact that we're going to put it into cash and not AR, and that's what we'll have here. So we're going to have cash. We got cash of 10,000 on our clearance sale. So I'm going to put that here. Right click, cash. We got 10,000. We're going to credit something. Now I'm going to credit this. I'm going to put this down in two separate journal entries. One, the sales journal entry, then account for the inventory, even though they happen at the same time. So we're going to credit sales, income. Income's going up by that 10,000. Right click, paste that, 1, 2, 3. Going to indent that, home tab, alignment, indent. Scrolling up, going to go to cash, double click. Going to the end of cash, plus, going to click on that 10,000, increasing the cash. So now we're at 103.2 cash sales down here. Going to go to sales, T14 equals the 10,000, enter. That brings income, net income up to 20. We've got revenue plus that gain, 20, but they're different in terms of taxes because one's capital, one's ordinary. Now we're going to have to unhide some cells up here to do the rest of it. So I'm going to highlight from H to R, let go, right click, and unhide. And then I'm going to hide this side. We don't need these anymore. I'm going to hide these. I'm going to go all the way to I maybe and hide these. We're going to hide, right click, and hide those. Then we don't need these yet. So I'm going to highlight from here to here, let go, right click, and hide those. And now we'll do the second half. So the second half of this is, of course, we had to give up the inventory in order to make that $10,000. Inventory needs to go down. Inventory is on the books for the 8,000. And of course, we just sold all of it, so it's all gone. So I'm just going to say inventory is going off the books. It's going to go on the bottom because it's a debit balance account. We need to make it go down. I'm going to go to the home tab, alignment, indent that because it's a credit. We're going to make our credits negative or bracketed numbers for 8,000. Then we're going to debit something for 8,000. That's going to be the expense related to the use of the inventory called cost of goods sold. So I'm going to copy cost of goods sold, put it up top in J4, right click and paste it, 1, 2, 3. All right, so we're going to post this out now. So we're going to go to cost of goods sold down here. This equals, and we're going to point to that 8,000. What's going to happen to the income, 20,000? It's going to go down because now we have an expense. So we've got income credit, not a negative number, minus the debit plus the credit, 12,000 income. Part of it's ordinary, part of it's capital. And then we're going to go up to T6 equals the 8,000, and that brings inventory down. That's what we wanted to do. We're selling off all our assets until we have just cash, and then we're going to pay off our liabilities. That's the normal process we would like to do when we close out the books. Now we're going to collect on AR. So we're going to go all to everybody that owes us money and say, hey, we're closing our business and we need to get paid now. So could you pay us now? And according to this, we got 9,000 of the 10,000 owed to us. So we're going to say, all right, we got cash 9,000. So cash is going to go up for the money that people owed us. Got more cash, 9,000. We're going to say that we have to get the whole 10,000 off the books because we're closing shop here. So we're going to take the whole AR, paste it here. Going to home tab, alignment, indent that. We're going to take the whole 10,000, credit 10,000 off the books. Now the debits don't equal the credits. I'm going to put an extra debit over here. And I know the 2 debits should go on top, but I'm going to put, 1 debit on the bottom. So hope that doesn't disturb anyone. And I'm going to say this equals the negative sum of the 9 and the 10. And we want to flip the sign to have a debit of 1,000. That's going to be, we're going to say, bad debt expense at this point. We're just going to write it off and say, we're not going to get that. We're going to have to just write it off. So, all right, we're going to copy bad debt expense. It's going to be a debit. J9, right click, paste it, 1, 2, 3. Let's record it. So we're going to double click on the cash. Go to the end of cash. We got more cash. We got this 9,000. And then we're going to go to accounts receivable. So accounts receivable, we're going to say that equals and point to the 10. And that's going to bring the receivable down. That's what we had to do to sell off all of our assets. All the green are 0 except for cash because we're going to use the cash to pay off everything and then pay off the owners. And then the bad debt down here, we're going to say that that equals the 1,000. Next thing we want to do is, of course, to pay off the accounts payable. So we'll pay off the accounts payable here. All right, so accounts payable is on the books for 15, so we're going to have to pay that entire amount off. We're going to pay it off with cash. Cash is going to go down then. So I'm going to copy that. We're going to put that on the bottom. I'm going to skip a line, skip another line, put it on the bottom, right click, paste it, 1, 2, 3, values only. Home tab, alignment, indent 1 time. We are going to put it on the books or record it for the amount in accounts payable being 15,000. We're going to debit something for 15,000, the same amount. And the debit will be going to the accounts payable, making that go down. So I'm going to copy that, paste the accounts payable, and we're paying off the accounts payable. Let's record that. We're going to be in cell T8 equals the AP, bringing the AP down because we paid it off. Then cash, we're going to double click on cash, go to the end of it, plus the credit to 15, bringing the cash down because we paid it off. Next thing we're going to have to do is to pay off the loan balance. So we still have the loan balance, 84,000. Now we have the cash to pay that off. So now that we sold everything, we can pay the entire loan off. So that's good. So what we're going to do is we're going to say the loan, well, we can say cash first. So cash is going down. Cash is a debit. We're going to skip a line, skip another line, put it on the bottom because it's a credit that we're going to make it go down by. And we can go to the home tab, alignment, indent. And then we're going to credit that for the 84,000. And then we're going to debit something for 84,000. That's going to be the loan. So I'm going to copy that. And I'm going to paste that right there. Paste it 1, 2, 3. And then we can post that out. So I'm going to double click on the loan over here. We're going to go to the end of it plus the 84,000, bringing the loan balance down. Then we're going to go to cash, double click, go to the end of it plus the cash, bringing the cash down. So now we only have the 13.2 left over that we can spend. Now note that we have this difference in our capital accounts. That should kind of go away now, right? Because we got rid of the loan. The only reason we had this here is because these people were liable for this loan that we now paid off and they're no longer liable. So this should clear up our problem now. Now we're going to eliminate the difference between the book balance in our capital accounts and the tax basis balance. So I'm going to scroll over here and we could do we can do it here first. We're going to say, okay, this needs to basically go away now. So for the tax journal entry, what's going to happen is this 84,000 that we paid off is no longer needing to be allocated to these folks. So we have to reduce their balance by that amount. The capital accounts or basis accounts have credit balances. We need to make them go down. So we're going to do the opposite thing to them. We're going to debit those. So I'm going to copy all 3 of those. We're going to debit those. And those are going to be debited for the 84,000 that they're no longer personally liable for, divided by 3. And that's going to be going to all of them, of course. and then we're going to say the negative sum of these items there. That brings the 84, and I'm just going to take that out of our kind of our plug account, our adjustment account. So I'm going to copy that, just our balancing account in the equity section, and go ahead and go to the home tab, alignment, indent that. And then we could just record these. I'm going to say, all right, so this should go away now. So now we got the 28, bringing it back down to 0, so it matches. So then we're going to double click here. We're going to say plus the 28, bringing that down to the 1001, matches. Double click the 28 plus the debit, bringing it down to the 1001. So now our capital accounts are back in balance, and we no longer have this adjustment here. So we no longer have this adjustment, and we're back in balance, and we can just close everything out now. So if we're going to take a look at that in a table, of course, same idea. If we're looking at it in a table, like you're going to see a lot of times when you look at, a lot of textbooks, you're going to say, okay, all right, we skipped the fact that the table, the last time that happened in the table, the thing we skipped is when A put some money back in order to get caught back up. So let's go ahead and put that in there. A put in, remember, 8,900 to bring their capital account back up to 0 for book basis. So that was this, and the total comes up. All right, that puts us back to where we were before this entry. Then we had the loan payoff. So the loan payoff was total of equals to the 84,000. So I'm going to make it a negative 84,000 divided by 3. And that's what brings the balance down to 0. So we're going to do that all the way across. The same 28, the same 28. And then if we were going to tie this back out to the book balance, we would have to say negative sum here. So these are the adjustments to the tax basis. This is kind of like the adjustment account, which tied out to this adjustment account, and that's going to bring that back down to 0, bringing us back to the book balance here. 1001 equals the 2002. Here's the 2002. So on a book basis, we're at 2002. On a tax basis, we're at now the 2002. So now we're back in alignment, whether we look at the trial balance or whether we look at a table. Okay, so now the next thing is we can just start to complete the closeout. Next thing we need to do is close out the income statement that we have earned through this time period. I'm going to go ahead and unhide our last column here. So I'm going to highlight from L to R. L to R, let go, right click, and unhide. And then I'm going to hide from M to E, is that it? And then right click and hide. Okay, so now what we're going to do is we're going to close out. So we're going to close out our income statement, and then we will finally pay off our capital account. So we can't really pay them off until we close this out, of course, because remember, these capital accounts up here represent the capital account before the close. The real capital account, if we just had one owner and we're just talking about capital as a whole, includes the equity section and the income statement. So between, if we were just talking one number with one owner, the in capital account should be 13.2, which of course matches the assets at this point because we don't have any liabilities or any other assets that matches what's in cash. So we need to close this out to the capital accounts in accordance with our profit sharing agreement. Then we'll have their capital accounts equaling the cash here. The capital accounts won't be equal to each other because of the difference in draws, even though they have an equal profit sharing, but the sum of the three capital accounts should equal cash at the end of the day if we close it out in this process. All right, so what I'm going to do is close everything out. So this is the income statement. We're going to close it out. So that's a credit. I'm going to debit the sales in order to close it out for what's in there, 10,000. Cost of goods sold is a debit balance. Therefore, we're going to have to credit it to make it go to 0 for a credit of 8,000 because that's what's in there. Bad debt has a debit, so we need to do the opposite to make it go down. So we're going to credit it by what's in there of negative 10,000. And the gain is 10,000 credit, so we're going to do the opposite and debit it for what's in there by 10,000. So if I highlight these and indent that. Now, if I just highlight these, I can see that, of course, that's going to equal net income. So 11 here, 11 here. That net income is what we need to allocate out. So instead of going in and out of a clearing account like income summary, I'm just going to go ahead and just post that 11,000 in accordance with the profit sharing agreement, which is just 1/3 each in this case. So I'm just going to just say that 11,000 is going to have to go, 1/3 here, 1/3 here, 1/3 here of the 11,000. So, and we could see that it's going to be income. So we're going to have a credit to plug this out. So I'm going to do it this way. I'm going to say the negative sum of these. That's the plug. That would be this. That would be a negative 11,000 if I was to do that. Let's do that. So there's the 11,000. I'm going to go back on there and I'm going to double click on it and I'm going to say that would be good, but I want to divide that now by 3 because we're going to allocate that to these 3 partners. Now it's not quite even. That's okay. I'm going to put that there. There's our 3 partners. Now each of them are going to get that much, 1/3 of that net income of 11,000 being allocated to them. Okay, so let's post this out. What's going to happen when we post this out? It's kind of an ugly journal entry, but let's just keep it in mind. All we're doing is making all these zeros, resulting in 11,000 net income that we then allocate in accordance with the profit sharing to the 3 partners in this way. So let's double click here. We're going to go to the end. That plus the 10,000 makes this go to 0. 8, double clicking on it, plus the 8 credit makes it go to 0. The 1,000 plus the 1,000 credit makes it go to 0. The 10,000 plus the 10,000 debit makes it go to 0. Then we have the 11,000 we're off by. We're going to apply that to our capital accounts. So we're going to say the first one plus the credit 3,337. Now he's got income again. This equals the 3,667. This equals the 3,667. So now we have the 13,2 and we have the capital accounts that add up to 13,2. So now we can just pay off the capital accounts. Before we do that though, let's keep in track this time instead of getting off of track here. We're going to go back over here and say we allocated the income. So it was income of 11,000 divided by 3, allocated evenly. So that's what we have here. Allocation tax now equals the book. So there's no difference there. And we're at 13,2. 13,2, adding these up, 13,2, adding these up, 13,2 equals the cash, 13,2. So then we're going to go back over here and then do the last step, which is just to pay out 13,2 to these folks here. So we're going to say, all right, now we can pay you off A, and you only get 3,667. So we're going to copy that, and we're going to say, all right, that's going to be a debit to make them go to 0. Now again, you would think a lot of times when I first learned this that it should be it should all break out to their profit sharing plan, but it doesn't because the profit sharing plan doesn't take into account draws. So it's not the profit sharing plan. The way that you distribute income does not align to the ratio of what's going to be in the capital accounts, but it should add up. This should add up to that. So if we do that, we're going to say it's the 3,667, 4,767, 4,767, and we have the credit negative sum of the, oh, what was that, 13, and now it's off by $1 because of rounding, but so let's just make it right, 132.00. All right, so it's off by $1 because of rounding. That's okay. And then we're going to say that's going to go to cash. Here's cash, and we could post that out, so we could indent that, home tab, alignment, indent, posting it out. All right, so I'm going to double click here, going to the end of it, and that's the 3,667. Double click here, going to the end of it, plus the 4,767. Double clicking here, going to the end, plus 4,767. Bringing everything down, and the cash is going down here. And we're off by $1, of course, but it's still green because it's within $1, so that's okay. All right, so then we're going to go over here. The same thing that happened. All we did was pay off the cash, and we paid off the 3,667. We paid off the 4,767. We paid off 4,767. Summing this up. And, of course, if we look at it in terms of a table, everything is 0 as well. We're off by $1, but that's okay. So that's going to be that. So we can see it in terms of a trial balance, if that's the way you're used to seeing it like I am, and in terms of course, a table, which is the way that most books will present it. And you can get some idea of the type of things that will throw off a difference between the book balance and the tax balance, especially related to the capital accounts when you're talking about a partnership, and the things that will drive them off, one of them being loans, and the things that the types of activities will pull them closer back together.